right. So on the ET Money Show, we make sure that we don't just talk about investing in mutual funds, but also help you meet the brain behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Trideep Bhattacharya, who is the fund manager of Edelweiss Midcap Fund and Edelweiss Focused Equity. Let's take you through this exclusive interaction. All right, good evening, Trideep, and welcome to the ET Money Show. And today we are definitely going to talk about the market and the year ahead. But then let me begin with the AMFI data that has come up. And although it's a mixed bag of numbers, but then one thing I really want to start off with is the small cap and mid cap inflow numbers, which has again reached a record high. Small cap, if we talk about, has gone to 2245 crores in December as compared to 1378 in November. And similarly, we've seen a record high number in the mid-cap funds, which is 1962 for December and 1176 in November. So let me begin with the investor sentiments and the kind of confidence we are seeing over here, especially in the mid-cap and small-cap category, because these numbers, especially in these two categories, are sustaining. The inflows are regularly, we are seeing since a couple of months, is coming at a high. So how do you actually decipher these kind of numbers and this trend of investors?
First of all, Kavita, wish yourself and all your viewers a very happy new year.
Oh, happy new year to you too.
And thanks for inviting me to your very popular show. Deciphering the data or seeing the data that I saw today morning, I think the way I read it is basically the investors' confidence in Indian equity markets, particularly from a medium-term standpoint, is growing. Generally, when investors look to invest in markets, they first test waters with large-cap funds or large-cap oriented funds. And generally, when the risk appetite tends to be a little bit higher, or their confidence in the economy tends to be a little higher, and the outlook tends to be longer, which you will see. But under those circumstances, we generally see the inflows into mid and small cap, particularly the mid cap category, grow over time. So I read this as a sign of increasing confidence of retail investors on Indian economy, and the mutual fund market being the poster child of that, is seeing the benefit of the same. Though I would say that I think the mood overall, having met quite a few distributors, is probably still a bit on the cautious side. But I think overall, from the bottom-up driver standpoint, from a medium-term standpoint, medium to long-term standpoint, the view is still positive. The flows are probably a reflection of the same.
Sure. I'm going to dissect further into the mid-cap space later on in our entire interaction. Now, the entire inflow, if we talk about it, equity, it has gone up threefold. But then still, if we compare it with maybe October numbers, there is a dip of somewhere around 21-22%. A lot of reports, Trideep, that we are reading is that the second half of 2022 is where the inflation has started pinching people, the investors, our viewers, in fact. So although they have gone out and really spent a lot during the festive season, but then the second half of 2022 has been reported where they actually felt the pressure of inflation. And once they feel it, the first thing investors do is either they stop their SIPs or maybe just reduce the amount that they are putting into a particular fund. Now, looking at the reduced inflows as compared to the October numbers, total equity inflows I'm talking about, do you see this going down further in a couple of quarters? Do you think the inflation will actually it will come right on their face? Do you see this as a problem coming up?
So I think it's a great spot. I would say I read the overall inflow number, or a little bit soft overall inflow number, a reflection of investors' appetite for equities, not just in India but globally, with regards to what they hear and see in the form of headlines. When one sees too many of our recession kind of headlines in media and COVID-related headlines coming out of China, one can't help but be a little more cautious or careful, and that is why you are seeing a little bit of money kind of moving in the sidelines, particularly because markets have done well. I mean, just to reiterate, we actually kind of, said beginning 2022, about a year or so, that this should be a tale of two halves, where we expected the first half to be fairly volatile stroke down and the second half to be reasonably robust. And we saw pretty much the same script actually flow through, with Nifty down about 16% in the first half and down in 19-20% in the second half. But the fact of the matter is that in the second half, investors saw good bit of returns come through, which is why kind of some bit of profit taking is reflected in the number that you sort of that you quoted. And the fact that the inflows still on a relative basis are more sanguine in mid and small cap tells me that the medium term outlook on equities, on Indian equities particularly, is or continues to be fairly robust.
Exactly, and although these are month-on-month numbers, but then a lot of trend spotting is evident from these numbers. You know, when we talk about inflows or outflows, and in fact, there has been outflows from flexi cap category and index funds. Deep, surprisingly, have also seen outflows. Now, looking at this particular trend, how are you able to gauge the 2023 start when it comes to investment in equity mutual funds?
So basically, our theme for 2022 was that it would be a tale of two halves, like I highlighted to you. Our theme for 2023 is we will probably face recessionary conditions before rebound. In other words, in our opinion, the first half, not just in India, but globally, if you were to sort of summarize the equity market environment in which we will have to play around, it will probably be recessionary conditions above, whether you look at United States, whether you look at Europe, and we will see how China evolves over time. Only as we get towards the back half of the year will we see the economy is probably bottoming out to a certain extent, inflation peaking out, growth numbers stabilizing, and probably better conditions from a news flow or from a headline standpoint. So I would say that we should be prepared for a reasonably volatile first half, followed by rebound or positive in the back half of the year.
Right. So do you think a weakening rupee is going to be the main factor behind this volatility that we're talking about? Because fiscal deficit and trade deficit is definitely a problem that's cropping up for us.
While that would be one of the reasons, one of the main things that we are seeing could be kind of one of the stumbling blocks for the market is over the last 6 months, equity markets globally have seen 500 basis point rise in interest rates, whether it's United States or more generally cost of capital globally. I think the impact of the same in the economies to various degrees is yet to be felt. I think in the first half of calendar year 2023, you will see some of the impact of the rate increases flow through the economic growth or economy in general. And I think that's what we are kind of mindful of as we begin 2023 in the first 3 to 6 months. We are not necessarily kind of saying that the world will get into a recession. Maybe certain countries, certain geographies will, but in general, we will see a bit of growth moderation, growth slowdown, particularly in the first half of the year, as a result of rate increases that we've seen in the back half of calendar 22.
All right, talking about fresh investments now, and no, before that, I really want to know the sectors that you're bullish on. You know, the first 6 months, especially, what are the sectors who, despite of this volatility on your radar, are going to perform very well, and investors, maybe if they want to go bullish on these sectors, they can actually try it out.
I think having been a proponent of long-term investing, I would probably kind of, from a sectoral allocation standpoint or thematic standpoint, I would not look at 6 months in isolation, but use the 6 months as an investment opportunity in tranches. All I'm really trying to say is that the volatile first half, one should invest in tranches. And in tranches, the themes that I would be bullish on, which I will be investing on from a 3-year perspective, are 4 or 5. The first thing in that context that I would like to talk about is after a good while, which is a decade or so, we are seeing good semblance of capex cycle coming through in India. And I think you will see a private sector driven capex cycle come out over the next 2 to 3 years. And I think the investors should use the first 3 to 6 months to position themselves accordingly for this to play out. That's number one. Second, after almost 4 to 5 years of cleanup, whether it's with regards to asset quality or for that matter liquidity, I think the banking sector is looking relatively kind of prompt for better growth rates and a better profitability, given that overall the asset quality fears have kind of receded. So the second theme would be positive on lending financials overall from a 2 to 3 year perspective. And the third thing that I would like to sort of highlight to all of you is basically the idiosyncratic country-specific themes, like, for instance, indigenization of defense. In my opinion, is a multi-year, close to a decadal theme, which will play out with regards to various companies that we can lay our hands on. Likewise, beneficiaries of China plus one theme has now moved on to Europe plus one theme. So these are very specific to India, but could benefit Indian manufacturing sector, and the allied companies could see meaningful spurt in growth rates over the medium term. So those would be a few areas that I would be positive on, particularly if I see volatility in markets.
Let's talk about mid-cap space now. After a very long period of underperformance and maybe negative returns, now there is some kind of a relief coming up in mid-cap and small-cap sector. Do you think investors should actually book their profits because they've been seeing this underperformance for a very long time, and now they are, if at all they are getting any profit on their portfolio, should they just wind it up and maybe diversify themselves in some other category, or is it the time to just stay put in mid-cap? Maybe if you have funds, you should even invest more.
I think overall, this is a relatively tough question to answer, particularly if you think about from a short-term standpoint, because we expect the market to be quite volatile. So in that context, I would suspect that all types of funds have generally a spot in the asset allocation, and I would say that overall, for mid-cap investors with 5 to 10 year time frame of investing, they should probably stay put in the fund, because overall the next 5 to 10 years, particularly the bottom up drivers that I highlighted in answer to your previous question, will play out and will be positive for Indian equities, over that time frame. And in that context, particularly in the mid and small cap categories, in the first 3 to 6 months of the year, if they're underinvested, take advantage of some of the volatility that we might see over during this course to add to the exposure overall. If investors are overexposed, or a certain set of investors are overexposed to mid caps as a category, maybe they could consider profit taking from a short term standpoint. But generally, mid cap investing, I would actually kind of encourage viewers to kind of take a reasonably long term view, and long term meaning 5 to 10 year view. And over the 5 to 10 year, from a 5 to 10 year standpoint, I think one should actually stay put in these areas rather than run away from it.
Right. Talking about your flagship scheme, which is going on for almost 15 or more years now, when you sit down to plan a strategy, with your team of fund managers, how do you plan to beat the volatility? Talking specifically about the mid-cap space, what are the sectors in this space, in the mid-cap space that you're banking on? How do you make sure, how do you ensure that you mitigate the risk of volatility for the investors that those have put in money in your funds?
I think this is a great question. First thing, and this is factual information. So overall, over the last 15 years, the mid-cap fund has generated close to 18%, CAGR. Now, while of course the disclaimer is that future returns are not or may not similar to the previous returns, but the fact of the matter is that 15-year time frame is a reasonably long period of time to give the investors a bit of gauge as to what kind of returns people have seen in the past in that context. So that's the starting point. Now, with that, generally one of the scare factors with regards to mid-cap funds, as you rightly pointed out, is the volatility. The way we at Edelweiss MF take care of volatility is not just to focus on the short term, which is the next 3 to 6 months, but orient the portfolios where we see potential earnings upgrade come through from the next 2 to 3 year standpoint. Generally, what we find that by putting an anchor around 3 year horizon, the outlook tends to be more stable, the view tends to be more sanguine, and we give a better opportunity to investors to actually play or benefit from this thing. The other thing to keep in mind, particularly from a mid-cap investing standpoint, is mid-cap as a category is basically a category which is full of successful small caps and aspiring large caps. So in many ways, if you look at the entire market cap spectrum, it captures the sweet spot of the listed space quite nicely. And hence, from that perspective, the themes that we talked about, or the sectors that I talked about earlier, which include industrials or capital goods or financials, or for that matter, defense or China plus one areas, these are some of the areas that we are positive on in our funds, keeping in the medium term in mind, which I just highlighted. And also, we think that quite a few companies in India, from a bottom up perspective, are kind of in the right spot to benefit from this over the medium term.
All right, last question to you, and then we wind up this segment, Trideep. Now, talking about individual financial portfolios. Now, is it the time to actually look into each and every investment instrument that you have in your portfolio, see the risk reward ratio, and then move on with it, or maybe stick to it? Is this the time when you need to reevaluate each and every investment instrument that you have, looking at the volatility and the uncertainty that's somehow is getting predicted?
I think investors should actually do this on a periodic basis, irrespective of this time or that time. But a few guiding principles at this point in time might come handy. I think the first thing to keep in mind is the point that I highlighted that the near term looks a little volatile. Recession before rebound in 2023. So maybe the first 3 to 6 months, use this as a time for volatility. That's one thing to keep in mind. The second thing to keep in mind from an asset allocation standpoint is that while inflation will come down sometime in the first 3 to 6 months, we have entered from a medium term standpoint inflationary environment. This is different from what we have been used to over the last 10 years. And generally, in inflationary environments, as an asset class, equities and gold, which should be part of investors' portfolios who are looking to do asset allocation. Now, the percentages can differ and based on the investor's appetite and whatnot, but generally, those would be some of the principles that I would leave with your viewers as they evaluate their asset allocation and investments at this point in time.
All right, so that's the mantra for 2023, and that's the learning which you need to implement. Thank you so much, Sudeep, for being on the show and helping our and guiding our viewers towards the financial portfolio.
My pleasure.